Hi, everyone. Thank you for joining for our webinar today in corporate tax regulations in the free zone versus the mainland with our partners from AMCA. Today, we'll be covering on some insights specifically for tech companies. So first, I'd like to tell everyone a little bit about Astrolabs and what we do. So Astrolabs is the Gulf's leading business expansion platform. We help companies that want to enter the market in the region, coming to the UAE or to Saudi Arabia as well. And here in Dubai, we have a tech community of over 200 tech entrepreneurs. We have over than 100 mentors. We have partnerships with different VCs and different angel investors. And essentially, we have weekly networking events. We do some recruitment. We do knowledge building workshops and boot camps. And it's just a really great community to belong to if you're a tech company that is starting out in the UAE or in Saudi Arabia. How we support here in the UAE, it's specifically with the business setup in DMCC. We're partnered with the DMCC where we support tech-enabled companies in accessing a discounted license with the DMCC. And we give them a membership, which includes the lease agreement and many other benefits. So just to give you an overview of what Astrolabs does, and if you're interested at the end of the presentation, of course, we'll share our contact information where you can learn more about Astrolabs. Now I'll leave it to Kurt, who will guide us on introducing AMCA and through the topic. Thank you, Kurt.
Thank you very much, Ms. Lucia. So we'll just proceed with a brief background about AMCA. So AMCA, Abdullah Al Marzuki Chartered Accountant, was basically established in 2010, and we have initially started as an auditing firm. So we have multiple branches with our headquarters stationed at JLT DMCC. And aside from being an MOE approved auditor, we also function as an FTA approved tax agent. So we assist with businesses who require assistance when it comes to their taxation requirements or auditing requirements as well. So that's just for the brief introduction of AMCA. Should we proceed with the webinar proceedings now?
Sorry. Yes, please. Continue on the topic.
Okay. So as the pointers for the webinar, we have divided it into 6 sections. So on the first one, we'll be going over with the general information for just a brief overview about it. And also we would be covering about the minimus requirements that a qualifying free zone person would need to meet, as well as for a qualifying intellectual property, which would be specifically applicable for tech companies. Continuing with the general information about corporate tax, as what you all know, corporate tax is a direct taxation, or it is also being called as corporate income tax or business profit tax, and it is levied on the net income or the taxable profit of corporations and other businesses, which has been introduced through Federal Decree Law number 47 of 2022, and which came into effect on 1st of June 2023. So it is a kind of federal tax that is applicable all throughout the Emirates and was introduced to basically solidify UAE's commitment on enhancing the tax transparency or prevention of harmful taxes, which would further fulfill the commitment to meeting the international standards. So as what is presented on the screen, it came into effect from 1st of June 2023. So businesses adopting a fiscal year starting from 1st of June 2023 until 31st of May 2024 would be the first businesses who would have their first tax period from the date of effectivity. So the tax period when it comes to corporate tax actually follows the financial year of the company. So entities adopting a fiscal year ending from 31st of December would technically be subject to it from 1st of January 2024 until 31st of December 2024. That is going to be their first tax period. And when it comes to the net income that was highlighted on the screen, it refers to the taxable income of the company, which is usually the accounting net profit or net loss of the businesses after making few adjustments that was defined in the corporate tax law. So this could be the allowable or disallowable deductions or expenses, tax losses, or tax reliefs that is applicable. So moving on with the scope or the person that will be subject to corporate tax, actually for that one, it could either be a natural person or a juridical person. So generally, a person conducting a business business or business activity as defined under corporate tax law is subject to corporate tax. So from the screen itself, we have categorized it into four, which is a juridical person, a natural person, and then on the non-resident side, we have non-resident juridical person as well as non-resident person. So on the juridical person, both the businesses that is established locally or within the UAE, as well as those that is incorporated outside UAE's jurisdiction, would be subject to corporate tax as long as it is being effectively managed and controlled in the UAE. And when it comes to their income, both the income that is derived from within and outside the UAE would be subject to corporate tax. Of course, there will be few exceptions of it, like for example, for incomes that certain incomes that is already taxed outside of the UAE jurisdiction would not be subject to corporate tax generally. Now, for natural persons, as defined in Cabinet Decision number 49 of 2023, a natural person would only be subject to corporate tax if they have a turnover of 1 million AED or they have a turnover exceeding this specific threshold. So on this specific legislation, they have also specified that there are few incomes that would not be included in the calculation of this 1 million threshold. So as such, for example, is the employment income, personal investment income, as well as real estate investment income would not be included in this specific amount. So for natural person, the incomes that are related to the business conducted within the UAE would be subject to corporate tax.
Kurt, just a question to clarify. Would this be someone, for example, a freelancer under a freelance visa?
Hi, this is Marie this side. To answer your question, a freelancer will be considered a natural person since it's not an entity, doesn't have a separate existence. So basically, we look at the threshold. If the business activity is earning more than 1 million, then they will be subject to corporate tax.
As a natural person?
As a natural person.
Perfect. Thank you.
Okay, so moving on with the next point. So we have on the other side the non-resident person, where it would be starting with non-resident juridical person who either have a permanent establishment or a nexus here in the UAE. So these juridical persons, even if they are non-resident, since they have a sufficient presence to be considered for a tax right in the UAE, would be subject for corporate tax. And also non-resident person, any person that is non-resident person who is earning a state-sourced income would also be subject to corporate tax on certain areas. So the incomes that will be subject who is earned by these persons are the incomes attributable to permanent establishment in the UAE, as state source income, as well as those income derived from a nexus or from an immovable property that is owned by them.
And could you provide an example of what a non-resident juridical person would be? It would be someone like in a real life scenario?
Yes, to clarify on that question. So a non-resident juridical person will be, for example, a foreign entity who is not incorporated in UAE, and they are providing a service to a client here in UAE, for example. So for them, we have to check first of all the income. Of course, they're driving from a UAE client, so it's a state source income. Secondly, the permanent establishment. How are they providing the service? Is there someone here in UAE having some kind of existence who is enabling the service to be provided to the client? In that case, they have a permanent establishment. And nexus as well. If not permanent establishment, do they have some kind of existence in UAE? If not, if it's just the company is operating from outside of UAE and due to the online marketing, they have arranged a service for the client being there. They don't have a permanent establishment in UAE, so they don't have sufficient grounds to be called a taxable person in UAE. So a non-resident person basically is someone who is not residing or who doesn't have a license in UAE. So a foreign entity, you can say in real-based scenario, somebody who is not incorporated in UAE at the moment.
Perfect. Okay, so it would be more of a case-by-case scenario of depending, it's a little bit subjective to understand how involved or what is that nexus here in the UAE.
Exactly. It's going to be case to case basis to check the nexus and how we can establish if whether they have a permanent establishment in UAE or not. Since of having an office in UAE is an obvious scenario of having a permanent establishment, but there are some other scenarios also where you could be considered having a permanent establishment. So it's basically on assessment basis and is subjective to the actual transaction of the entity being held.
Perfect. Thank you for clarifying. And I see that a question has come in, a few questions questions have come in. We'll be answering questions at the end of the presentation.
Okay, so I hope we're able to clear this out. We'll be moving on with the next slide that we have. Okay, as we are already done with the general information for corporate tax, we would be moving on with the different treatment of the mainland and free zone companies. So acknowledging that the free zone plays a pivotal role in economic growth of UAE, basically attracting investors and solidifying the image of UAE as a leading business hub, the corporate tax has specific regime for a free zone wherein they have called it as a qualifying free zone. And mainland companies and free zone companies who is considered as qualifying free zone has a different kind of obligations as well as treatment for corporate tax purposes. So we would have it identified one by one, starting with their administrative obligations. So on the very first one, we have the registration. Both of the mainland, or irrespective whether the company would be in mainland or in free zone, would be required to register for corporate tax purposes and obtain their corporate tax registration number. So as for the deadline, there's no difference when it comes to deadline for both of it, as it is stated or mandated that all taxable persons should register for corporate tax before filing their first tax return. Now, after the registration, of course, the company would be obliged to file their tax return or corporate tax return. So filing of tax return would be done on an annual basis. And again, it is going to be irrespective if the company is from mainland or free zone, or irrespective no matter how low or how high would the company have as an income. So the filing or the period of the filing that would be followed, as I have discussed on the first slide that we had, would be the financial year of the company. They would be following the same tax period for filing of the returns. Now, moving on, the third point, as what you could notice, for mainland companies, their financial statement must only be audited if they have reached specific threshold as mentioned on the legislation. So we have specified it as 50 million AED, as what is stated on the law or applicable legislation. Whereas for a qualifying free zone person, if the company is qualifying free zone person, they would be required to have their financial statement audited on an annual basis, as well as to oblige with the transfer pricing documentations that is specifically for transactions with their related parties. So from this specific comparison, we could notice that even if a qualifying free zone person would have some incentives when it comes to tax rate, a qualifying free zone person would have a more extensive administrative obligations compared to those companies that is operating in the mainland.
Okay, thank you for that, Kurt. And just to clarify, there's some people asking what is a qualifying free zone. This is a qualifying free zone person, which we will go into detail in the following slide, I believe. I did have a question for you, Kurt. Does that mean that companies that are registered in any free zone have to audit their financial statement?
Hi, to answer that question. So no, not all the free zone entities have to audit their financial statements. Only the entities which qualify as a qualifying free zone person and are able to avail that status or criteria, only they have to get their financial statements audited every year.
Okay, perfect. So maybe we can go into the next slide because I see a lot of questions of what a qualifying free zone person is.
So moving on to the next slide, we have here the tax rate and applicable reliefs or incentives compared to mainland and a free zone or a qualifying free zone person. So for the tax rate that is applicable for businesses operating in the mainland, basically their taxable income up to this specific threshold, which is 375,000 dirham, would be taxed at 0%. So if the company is earning below this specific amount, they would still not have any liability as it is going to be taxed at 0%. However, any income that would exceed 375,000 EED would be taxed at 9%. Whereas on the qualifying free zone person, they have a different basis on the tax rates that is applicable to them. So for qualifying free zone person, they have specific term as a qualifying income, which we'll be discussing as well in the following slides for clarification. This specific income would be taxed at 0%, whereas their income that would not be considered as qualifying income would be taxed at 9%. For tax group is available for mainland companies as long as they meet specific criteria or condition as mentioned on the law. Like, for example, there is a common ownership of 95% and some other conditions as well. But for a qualifying free zone person, if a free zone entity is considered as a qualifying free zone person, they would not be able to join the tax group until they elect themselves to be subject to the standard rate of corporate tax. The same thing is the scenario for the small business relief, wherein a mainland company could apply small business relief for them as long as they meet specific condition. Like, for example, the main one is that the revenue should not be exceeding the 3 million dirhams at threshold, and it is not going to be applicable for a qualifying free zone person. And transfers of tax losses and transfers within qualifying group is applicable for mainland company, again subject to certain conditions, and both of this is not going to be available as well for a qualifying free zone person.
Okay, perfect.
Okay, now we'll move on to the highlight of this specific presentation for qualifying free zone person. Now, for qualifying for a qualifying free zone person, you should first check with yourself if you are considered as a free zone person under a corporate tax regime. So on the presentation, we have just added 2 questions that would help you identify it initially. So the first one is going to be if you operate in a free zone. So technically, if you're a qualifying free zone person, most of the operations or transaction that you will be having is at least to be operated within a free zone, as well as if you are a free zone person itself. So a free zone person is defined in corporate tax law should be a juridical person. So a person who is considered as a natural person or a person under an incorporated partnership would not be qualifying as a free zone person. As I have mentioned, it is defined to be a juridical person that is established within the free zone. Now, to further qualify for a qualifying free zone person, there are at least 6 criteria as prescribed by the law and the applicable legislation. So the first one is going to be if you maintain adequate substance in the free zone. So maintaining adequate substance is ensuring that your business is having enough present within the free zone. This could consider having enough assets to operate, having qualified employee. And they have also mentioned that it is possible to have an outsource when it comes to this, as long as there is an adequate supervision on the person that you have outsourced to conduct your operations or your transactions. So the next one is going to be for deriving qualifying income. So a qualifying free zone person should, of course, derive a qualifying income that would be taxed at 0%. And following that, the person should not elect to be subject to tax at the standard rate. So from the previous slide that we have, you would have an idea on why a free zone person would at least elect to be subject to a standard rate. So for a free zone person to be considered as a qualifying free zone person, they must not elect to be subject to the standard rate for corporate tax. Then again, the transfer pricing requirements and necessary documentation is mentioned as one of the requirements for it, for their transactions with the related parties. And the additional 2 is that the qualifying free zone person must meet the de minimis requirement. So the de minimis requirement, we would be discussing it further on the upcoming slides that we have. And the last one, which we have already mentioned on the initial slide, is the preparation and maintenance of the audited financial statement. So these 6 criteria must be met by the free zone person to be qualified as a qualifying free zone person. And in case they would fail to meet any of these criteria, they would not be qualified as a qualifying free zone person from the start of that tax period where they fail to meet one of these criteria and the subsequent 4 tax period.
Meaning that if they don't meet the requirements, they are subject to that 9% corporate tax.
Correct. So if they would not be meeting these specific requirements, then they would be subject to the standard rate of corporate tax.
Okay. And specifically, can you provide an example of what would be qualifying income for a technology company that's located in a free zone, and what would be excluded?
Yeah, sure. Actually, we would have an upcoming slide for a qualifying income, but just to give you a brief about that, it actually depends on to whom the tech companies is transacting with and what kind of activity they are performing. So basically, just to give overview of it, a qualifying income for a technology company that is operating in a free zone will be all the transaction that they would have with a free zone person, but just note that it should be a business to business only, which should not be from the excluded activity that we would be showing on the upcoming slide. And for the transactions that they would be having, let's say with a non-free zone person, this could include income from a qualifying intellectual property, which we would also be discussing on the following slide, and any other income that is out of the qualifying activity as long as they would meet the de minimis requirement.
Okay. Sounds like we need to go forward with the slides to understand a little bit further. Before we move forward, I have a poll I would like to launch. So if the attendees can please answer the questions that you have on your screen. It's 4 questions just to understand a little bit about who's joining our webinar today, who our audience is, and what we can focus on when answering the question. I'll give a couple of minutes just because we do have a lot of attendees. So I'll give a couple of minutes for people to reply to the poll, which are mainly yes or no answers. So it should be pretty straightforward. Okay, so I see that a lot of our audience are people that have entities already set up here in the UAE, many of them in a free zone. So it's good that, and a lot of tech companies. So we'll focus on answering questions that are related to free zone. Okay, wonderful. Thank you everyone for participating in the poll, and we can move forward.
Okay, so moving on, we would be discussing about the qualifying income. So qualifying income for a free zone person, we have made a specific matrix for you to understand to whom you are dealing with and what kind of activities you are performing. So these are the 2 things that you have to consider for you to be able to categorize your income properly, whether it would come on the qualifying income or it would not be falling under the qualifying income. So on the first column that we have those for if you are transacting with another free zone person as well. All other transactions that you would have, as long as it would not fall under the excluded activities as what is mentioned on the presentation, I would be considered a qualifying income. So the excluded activity that they have specified are, for example, transactions with a natural person with some exemption on some activities, which we'll also be discussing moving forward, and regulated banking activities, insurance and finance and leasing activity, as well as ownership or exploitation of immovable property other than commercial property located in a free zone, where the transaction is in respect of such commercial property that is conducted with another free zone. So the only thing that you have to keep in mind is if you are dealing with a free zone person, as long as it is a business to business, as what I have mentioned initially, and as long as it would not be falling generally on these excluded activities that is presented, then that certain income would be considered as a qualifying income. Now, on the other hand, if you are going to deal with a non-free zone person, or if you have a transaction with a non-free zone person, only the activities that is listed as a qualifying activity would be categorized as a qualifying income. So the qualifying activities are, for example, the manufacturing and processing of goods or materials, the trading of qualifying commodities, holding of shares and securities for investment purposes, which should be at least held for a minimum of 12 months uninterrupted, ownership, management, and operations of ships, regulated reinsurance and fund wealth management services, headquarters services and treasury financing services to related parties, finance and leasing of aircraft, logistics services, distribution of goods or materials in or from a designated zone. And if you are going to consider the distribution of goods or materials in or from a designated zone, it should be noted that the goods should come from or should pass through a designated zone itself. So only these activities would be considered as a qualifying income if you are dealing with a non-free zone person. Now, if you are dealing, let's say, for a natural person, there are only certain incomes that we can consider as a qualifying income. So these are the ownership, management, and operation of ships, fund management services, wealth and investment management services, as well as the financing and leasing of aircrafts. Now, the additional one that could be or mostly going to be applicable for tech companies as well is their incomes earned from a qualifying intellectual property asset would also be considered as a qualifying income. So income that is derived from, let's say, the ownership or exploitation of a qualifying intellectual property shall be calculated in accordance with the decision issued by the minister. The qualifying intellectual property assets, we would further be defining it on the upcoming slide, but technically it's going to include patents, copyrighted software, or any right functionally equivalent to a patent that is both legally protected and subject to a similar approval or registration like the patent or copyright software. But again, any other income that is provided that the de minimis requirement is met would also be considered as a qualifying income. So there are a lot of scenarios when it comes to this one, since a company could earn both a qualifying income and a non-qualifying income. However, when it comes to meeting the de minimis requirement, if the company were able to meet this specific requirement, then even their non-qualifying revenue would be considered as a qualifying income and would therefore be taxed at a 0% corporate tax rate.
Perfect. I think we should move forward to the de minimis test requirement just to understand, because I know that many of the companies that at least we deal with at Astra Labs don't qualify exactly in, for example, if they're not dealing with another Freezone person, maybe their clients, they're providing software as a service to someone outside of a Freezone or internationally, they would not qualify within this slide. So it probably is in the de minimis requirement. So let's have a look.
Sure. So we'll be moving forward with the de minimis requirement. Yes. So the de minimis requirement basically states that it shall be considered satisfied if the qualifying Freezone person's non-qualifying revenue does not exceed the percentage of the total revenue, which is at least 5% in that specific tax period, or the prescribed amount, which is 5 million, whichever is going to be lower. So on calculating which income you would include on the non-qualifying revenue and which income you would not include on the total revenue as well, we have specified it on the presentation for easier reference. So for non-qualifying revenue, these are the revenue that you would derive from the excluded activities, the activities that are not qualifying activities when you are dealing with another person or when you have another transaction with a non-Freezone person. And lastly, the transactions with a Freezone person where the Freezone person is not the beneficial recipient of the relevant service or good would be calculated as a non-qualifying revenue. And certain revenue should also not be included in the calculation. Like for example, the revenue that is derived from certain transactions in relation to immovable property located in a Freezone, revenue attributable to a domestic permanent establishment or a foreign permanent establishment of the qualifying Freezone person, as well as the revenue that is derived from the ownership or exploitation of intellectual property, except for the revenue related to the qualifying income. So these three revenue are usually categorized as automatically the taxable income of the company, which is actually taxed at 9%. Now you might get confused why on the previous slide we have noted that incomes from a qualifying intellectual property could be considered as a qualifying income, whereas on this specific slide, we have also mentioned it that it should not be included on the calculation for meeting the de minimis requirement. So the reason why is even for the incomes that is earned through a qualifying intellectual property, there is a specific calculation which we will also be discussing, and any excess amount that you have earned from that specific income would automatically be taxed at 9%. Or the standard rate, or would be considered as a taxable income of that company.
Okay, and could you provide an example, because it's a very dense subject for anyone that doesn't come from an accounting or a tax background. Can you provide an example of what this would look like, what this would mean for a tech company? Let's say a tech company that they're located in a Freezone, they're a qualifying Freezone person, and they've developed their own software or their own app that they sell to everyone around the world. How would their revenue be divided, in what would be taxed and what wouldn't?
Hi. So if that is a qualifying intellectual property based on the criteria that Ms. Kurt has already mentioned, the calculation is already prescribed by the ministerial decision. There is a specific formula given, a calculation formula given by the ministerial decision that you have to use to specify which amount you are able to account as a qualifying income and which amount you have to, which is excess and which will be taxed at the standard rate. If we come on to the next slide, it's going to show you the exact formula of how to calculate that amount. Giving the conditions, conditions basically are very for the intellectual property. They're just regarding the classification of, first of all, the asset or the IP asset, whether it is going to be considered. For example, there are some marketing related IP assets like trademarks which are not being considered qualifying IP assets. So in respect of that, it needs to be assessed whether that IP asset is actually meeting the criteria of being a qualifying IP asset. If yes, then we need to use that calculation to calculate the amount of the income which is allowable to be categorized as the qualifying income from IP asset in that year, and the excess amount will be calculated based on. So if we move on to the next slide, I think we will be more sure about how to calculate the income as your question is based on.
Perfect. Thank you.
Okay, so moving on to the next slide, as what Ms. Mariam have mentioned, we have here the specific calculation and how you'll be able to identify which income would be a qualifying income from those income that you have earned from a qualifying intellectual property. So the applicable legislations we have mentioned on the screen as well, which is Cabinet Decision number 100 of 2023 and Ministerial Decision number 265 of 2023. So qualifying intellectual property, as what I have mentioned, it could include the patents, copyrighted software, and any right functionally equivalent to a patent that is both legally protected and subject to similar approval and registration process to a patent. And however, as what Ms. Mariam had mentioned upon answering the question, this should not include any marketing related intellectual property assets, like for example, trademarks. So there are still certain kind of intellectual property that could not be considered a qualifying intellectual property. So following that, the formula that has to be used is the qualifying income equals the qualifying expenditures, which means the expenditures that is incurred to fund the research and development activities that is conducted either by a qualifying Freezone person or outsourced to, let's say, any person in the state or any person outside the state that is not a related party. These expenditures are directly connected with the creation, invention, or significant development of the qualifying intellectual property, plus the uplift expenditures, which is defined as the qualifying expenditures increased by 30%. So just to note on that, the uplift expenditure shall only be applicable only to the extent that the qualifying expenditure after being uplifted is less than or equal to overall expenditure. Now it's going to be divided into the overall expenditure as I have just mentioned, which means the total expenditures, including the acquisition costs of the qualifying intellectual property times the overall income. So this is the specific formula that has to be used by tech companies having an income from qualifying intellectual property to know how much of the income would be qualified as a qualifying income and how much of the income would be taxable on the standard rate when it comes to corporate tax. So as I have mentioned on the screen, as specified on the screen, any income in excess of qualifying income calculated shall be considered as a taxable income.
Okay, so it is a very case-by-case scenario of trying to understand what the company does, and it has to be registered intellectual property.
Correct. It has to be registered intellectual property.
Okay.
Yeah. So aside from this specific computation, again, for an intellectual property to be considered as a qualifying intellectual property, there are some certain documentation that the company must keep within their record, which is the ownership and the right to exploit that specific qualifying intellectual property, the record pertaining to the qualifying expenditures and overall expenditures that is incurred, the overall income derived from the qualifying intellectual property, as well as the documents that would show the link between the expenditures and incomes that we have mentioned, like the qualifying expenditure and overall income derived from that specific qualifying intellectual property. So all the documentation that would relate on that intellectual property must be kept within the records of the company.
Okay.
Yeah, so just to give you as well a clearer picture, applying all the discussions that we have for a tech company, we have provided one scenario for you to be able to understand how a qualifying Freezone person would apply for tech companies itself. So here we have tech company A is a Freezone person who earns from royalties, let's say for their copyrighted software, which they owns and has a total revenue amounting to 100,000 AED from transacting with a Freezone person. And as for the assessment, it has met all the criteria for a qualifying Freezone person as prescribed in the law. So they have met all the 6 criteria that we have mentioned so far. But however, during the tax period, tech company A have earned certain income from dealing with individuals amounting to 4,000 AED, and the rest of the income, 96,000 AED, met the criteria of a qualifying income. So as the non-qualifying revenue meets the de minimis threshold of all their income would be considered as qualifying income, and tech company A would be considered as qualifying prison person itself. So from this specific scenario, I have highlighted the things that you have to note or consider as well upon assessing whether you would qualify for a qualifying prison person and whether your income would be categorized as a qualifying income. So for this specific scenario, they have mentioned that they have a total revenue of 100,000 AED from transaction with a prison person, considering that this free zone person they are dealing with is a business to business only transactions. However, they have an income from an individual as well, which is amounting to 4,000 AED, which we could include as a non-qualifying revenue of that company. So the 4,000 AED is meeting the de minimis threshold that we have mentioned, which is either the 5% of the qualifying revenue or the 5,000 a month. So that is why even for the other income of that company, it would be considered as a qualifying income, and the tech company A would also be considered as a qualifying free zone person.
Okay, that's clear. I would like to change the scenario a little bit because looking at the questions, I see that a lot of the people who are here obviously transact here in the UAE with other free zone people, maybe with a B2B in the mainland, but a lot of them also transact internationally, be either with other GCC countries or other regions. In this case, if the total revenue is not 100% from another free zone person, how would that change the scenario?
Hi. So basically, it depends. For example, if it's a qualifying intellectual property being used and the non-qualifying income you're earning from outside of UAE, which is not with a free zone person, if it's not meeting the de minimis criteria, then you won't be able to the qualifying free zone person. But if it meets the de minimis criteria, like it's less than 5% of your total taxable revenue, as Ms. Kurt has mentioned earlier, taking into account whatever we take into account to calculate it and what we are excluding to calculate the total revenue. If it's not meeting the criteria, then it's going to disqualify the person from being a qualifying free zone person, and they won't be able to avail the benefits of being a qualifying free zone person.
Okay, perfect. That's clear.
Okay, so that's it for the presentation. Maybe we could proceed now with the question and answer portion.
Yes, definitely. So let's see the questions that we have here. Okay, so one of them is similar to what I just asked. What if all the clients or transactions are outside UAE and free zone only? We have a lot of questions about non-qualifying free zone companies. So we've been speaking about how a qualifying free zone person has to meet all 6 criteria. What happens if there's a company that's located in a free zone, but it doesn't meet all the 6 criteria or the de minimis requirement? How does a non-qualifying free zone company or person move forward? Are they just taxed at 9%, or is there something else that goes into them?
Yes, thank you. So basically, if you do not meet the criteria of being a qualified free zone person, then you will be treated like just like a normal taxable person, and you will be treated at standard rate of 9% above 375,000.
Okay. Then we have another question saying having office and license under DMCC registration, is that considered a resident? If this company has 100% ownership in another company outside the UAE and their income is from the GCC, is this subject to tax?
So to clarify, you said that they have a license in DMCC and they have an ownership in another company, a foreign company. So that means, but they are earning income from UAE also. They already have a license.
Outside UAE. The income is from outside UAE from GCC.
It depends. Basically, first of all, they are registered in UAE, so they are a taxable person in UAE because they have the existence in UAE. They have the permanent establishment. They also have the nexus in UAE. About the income, since it's being earned from outside of UAE, it depends if whether it's already taxed outside of UAE under that company's regime, because under the double taxation agreement, if a income is already taxed outside of UAE, for at least equivalent to 9% or more than 9%, then they don't have to pay tax again here in you. But the filing will be necessary to avail to subject to submit the records for that income, how it's being taxed outside of UAE. And secondly, there has to be specific assessment to be done, because if the income is earned 100% from outside of UAE, and there are two companies involved here, one is outside of UAE and one is in here in UAE. So we have to assess the exact transaction, the scenario, how and who is earning the income, and how the clients are being provided the service that is earning the income outside of UAE.
Okay. And in the case that they're not getting taxed outside the UAE, or there's no double taxation agreement, they would have to pay tax.
Yes, if the income is earned by the DMCC entity and it's not being taxed outside of UAE already, they have to pay tax here in UAE for that.
Okay. What about offshore companies? Are they required to register and pay for taxes?
For offshore companies, the same criteria we have to check whether they have any kind of nexus in UAE, because for offshore companies mostly they are not performing any kind of trading or other activities in UAE. But for some of the offshore companies, they do have trading license also in UAE. So we have to check specifically what their establishment here and what their presence in UAE is for each company.
Okay. And then we have a couple other questions. These will be the last two. Can a qualifying Freezone person accept the exemption limit of 375,000 for their other income, which is not from qualifying activities?
I believe yes, because the qualifying income anyway is 0%. So the taxable income, it will be assessed separately from the qualifying income. If it's because there are two things. First of all, there is taxable income which is not going to violate the de minimis criteria. For that income, yes, the threshold will be applicable. But for the income which can violate the de minimis requirement, if it violates, then anyway it's not a qualifying Freezone person. But if the taxable income is the one which is separate from the qualifying income, then yes, the same pattern will be followed of 375,000 at 0%, and the rest will be at 9%.
Okay. And finally, how many employees is needed to be a qualifying Freezone person?
No, it depends on the size of the business and the nature of the activities, because it has to be an adequate number of employees. So it depends on the nature of the business, and secondly, the size, the overall scope of the business.
So, for example, we at Astrolabs, we only work with tech companies, and a lot of our companies, most of them are very lean. So they will have 5 or less employees registered here in the UAE.
Okay.
So would, in that case, because it's a tech company that, let's say, has developed their own software or their own application or their own platform, and they're providing a service, would they need more employees registered in the UAE, or are the employees considered globally?
No, foreign employees are also considered, but the main activities which are handled for the UAE company, there should be enough employees here to be able to handle the core activities of the company from here in Freezone. Or the presence of employees should be enough for them to handle. If there are some extra staff outside of UAE, which is support staff, that is fine, but there should be enough adequate staff to handle the activities which are being done in UAE itself. So it's subjective. Basically, the law does not guide you with the number of employees that you should keep, but it depends on the judgment and the assessment of the business itself. Whether they think the business they're conducting within UAE, the employees which are present in UAE, who are qualified, are able to handle them well, then it's fine. It's as per the services as well, because the goods trading businesses, they need more employees than the service sector. So it depends on the nature and the understanding of the business.
Okay, perfect. Thank you. That was our last question, as we've already run over time a little bit, but thank you everyone for attending. If you have any further specific questions, please feel free to reach out to AMCA. And if you are looking for setting up a business in a free zone, and specifically in DMCC, please reach out to me, lucia@astrolabs.com. You'll be receiving a thank you email with our contact information. Thank you everyone for attending the webinar. Thank you, Kurt. Thank you, Miriam. Thank you, Mohammed, for joining us today.
Thank you so much.
Thank you.